Welcome to this edition of Business Redefined. Centum has just released their numbers, and we are privileged to have the man in charge of the entity, Dr. James Mworia. Welcome on site.
Thank you, Julian.
James, I must tell you, a little bit disappointed, quite surprised by the dividend, especially because two factors here. Centum's dividend policy is quite clear.
Yeah.
And if you look at the share price, the consolation is always in the dividend payout. So where are you leaving your shareholders with this?
No, thank you, Julian. You know, as a board, you have certain considerations to make. For one, none of us expected that we'd be where we are with the COVID-19 pandemic. And it's taken a heavy toll on a number of our portfolio companies. And dividend is paid from cash receipts, dividends and the rest. So a lot of our companies have reduced their dividend, but the challenge we had in making this particular decision is that if we were certain that the environment is fully recovered, then we would have probably just retained what we had last year. But there was a lot of debate on the board as to the outlook and whether we would have a fourth, fifth lockdown, as to what would happen with elections. And the view was that we should do what is in the best interest of the company and build resilience. We have, you know, business is about strategic choices. You can't do everything. So in the beginning of 4.0, the key focus was building resilience, retiring the debt, and I'll speak a lot about that. And we've come down, we've retired about 13 billion of debt. There was a view that the focus should be on further retiring of the remaining debt, and that's where the priority should be, so that we can prepare the company to withstand whatever economic shock may come down the road. So yes, I know it's disappointing, it's not what we would have wished, but we had a lot of balancing to do. And we really declared almost the maximum of what our cash profits were in the year, because the year we made 245 million and we declared 217. So we're almost, so you can see how hard we tried to push the envelope. But there was a lot of reluctance around distributing prior capital, especially in the context of the outlook on the environment. And as I said on the call, there are a lot of things that concern us, but there are a few things that you influence. And I think the things that we have shareholder representatives on the board, and we had this debate with them. And actually one of them told me, look, I'll take a longer term view, because if you build resilience in this business, I see it generating a lot more for us than this particular year, which is an exceptional year. We've seen very strong companies declare dividends and even pull back after declaration. So it's we are not dealing with a usual set of circumstances. It's a very unusual set of circumstances, but we nevertheless balanced, give our shareholders some distribution, and we continue to work just to see what else we can do.
But James, considering the extent to which in the recent past you have deleveraged your balance sheet, I really thought you'd had wiggle room around the dividend.
No, we do, but you see, it's a view, and there's a lot of uncertainty still in the environment. And Julian, you know, you followed our company for a long time, and you know the bulk of our cash comes from exits. Exactly. And you know how the investment environment is. In fact, from 2010 to 2019, we've had exits every year. This is the first year we've not had an exit. And one does not know what the outlook looks like. So there's a feeling that the priority should be on further building of resilience for the business to withstand any shock. So it's not a one-man decision. It's a collective board decision, and on the balance, the view was then let's pay a reduced dividend in line with what cash operating profit we made. Personally, for me as a CEO, it's not a result I want to deliver for my shareholders. So it's personally very disappointing. But we just have to work harder, to make it up for them.
James, you spoke about one of the options on the table was potentially winding down your debt further. It gets me a bit concerned, because Centum has been very aggressively deleveraging the balance sheet. And at this point, are you putting form on the runway, anticipating a cash call from one of your portfolio companies, or what's the situation?
When I took over this business as CEO, I found exactly 10 million shillings of cash in the bank. and an overdraft of 180 million shillings. The shareholders were not willing to put in capital, so we could only grow through debt. But the business model was invest, grow the asset, exit, because the dividend yield is lower than the interest cost. So that debt-funded investment model works in a growth environment where you can see growth that exceeds the cost of the borrowing. When we came to 2019, and I think that's the advantage of having diversification, and you can see the indicators. The indicators were that there was general slowdown. And we took the view that the environment would operate in 4.0 would be a more difficult environment. That was even before COVID. And therefore the decision was made, because you've built capital, preserve that capital. You don't want to lose what you've built by then carrying on accelerating, having debt, then selling in a distressed manner to pay the debt. Sell at your convenience, pay down the debt, preserve capital, and wait for another round of favorable economic opportunities to reinvest. So it's a cycle. It's the same thing that private equity funds do, where they raise capital from investors and they return it after 10 years. The only difference with us is that we borrowed the money, and because no shareholders put in money in this business. I've not had that luxury of having a rights issue or an equity issue, and we've returned almost 4.1 billion shillings of capital. Plus, in the last 2 years, paid almost 13 billion shillings of debt back. So we were sort of at the end of that cycle, and then also build a marketable securities portfolio, so that then would invest income rather than capital. So it's sort of finding a business at one level, taking it to another level, and say, look, in the beginning, we were risking borrowed capital. Going forward, you don't want to even to risk borrowed capital. You want to risk income. So that if you put money in a PE business and does not work, you have income next year to reinvest. And we're in that transition. And we've made good progress because we've reduced the debt by 80%. We've increased, the target was to push marketable securities, the yield portfolio, to 10 billion. We are now at 7.5. We are at 75%. But so it's about choices. I wish we could do everything.
But you can't.
But you can't. And still, you then had COVID. And it looks like one is not sure. Like, look at our business in Uganda. It had really picked up. They've had a 42-day lockdown. I think it's ending. There's a time when all our staff in the office had contracted COVID. So you have had these opens, lockdowns, and the rest. So I think, sometimes one has to, you say I don't talk much about the operating environment. And I always believe you can swim. But sometimes one has to appreciate the environment they're in. And say, okay, then, you want to live to fight another day, and you have to take certain decisions, and these are some of that's where we are.
James, understandably so, your investment income took a significant dent, and that really reflects the environment outside there. But I look at this in two ways. One is that COVID could have been a double-edged sword from a PE standpoint. So on the one hand, exits are almost impossible, but on the second hand, maybe there's an opportunity for very attractive multiples in the market.
That's true.
So how is your pipeline looking like?
That's true. The pipeline is looking strong. And there are very attractive opportunities that have come in the market because of either you had leveraged too much and you are sort of caught up and we are having discussion. The only question you have in terms of when do I pull the trigger? Because the enemy of return is time. So if you invest and it takes you a lot longer to get started with what you're going to do, particularly where companies have been affected on the revenue side. And when one is not clear what's sort of the outlook is going to be, then you sort of take a more conservative view. Because the last thing you want, Julian, is to deploy capital and then start booking impairment provisions immediately after you've made the deployment. So, the Bible says there's a time for everything. The time to be aggressive is the time to be conservative. I think in the growth years, there was probably no company more aggressive than us. Yeah. So it's not that we cannot be aggressive. We have capability to be aggressive, but also there's a time to watch and wait and see, particularly because we are still exposed and we see how you have the ups and downs. And the thing we don't want to risk the capital, because it has been hard and very, very hard and capital. Yeah. So yes, there's a pipeline, and we've looked at over 200 deals. And the first question I ask when they come to management IC, it's not how much money we can make, it's how much money can we lose. That's the first question I ask, and many don't even pass. And how long will it take? The value creation process, the steps that you intend to take, just how long will it take us? Because we also have a number of companies in the portfolio that we're dealing with. And you don't look at the asset, you also look at your portfolio. Yes. And you say, okay, why don't I first deal with these ones and unlock the value? So those are some of the sort of balancing act we have to make as a CEO. So for me, the choices we've made as a company and as a board are clear. Is in the last 2 years, build resilience. So pay down the debt, that's 13 billion. Build up marketable securities, that's about 6 billion. So that's 23 billion, which if we did not make those decisions, would either have been paid out as share buyback, dividend, investments, and it would have made a lot of people very happy. But the question is it the right decision in the current circumstances?
Yeah. I see. Yeah. You prompted my next question, because I didn't anticipate you'd have such heavy impairment coming through your P&L. And the question here is this: you spoke about the capital restructuring for TRDL, and right now at 58% of a stake, the dilution, what's your target in terms of where you want to arrive at?
In my experience, companies have ups and downs. In fact, one of our best performing company, Almasi, there's a time it was really doing badly. So it's like a boat, you weather the storm. So the idea we have is bring in more equity into the balance sheet and pay the debt and be diluted. And wherever we end up, we end up. And then you ride again. That balance sheet should not have that much debt. The challenge obviously has been because we are not the only shareholders. We are not as nimble on decision making as we are on our other companies. You have to bring a lot more people along with you. But we are now there. And I don't know, we maybe end up at 30%, maybe that 5%, but it doesn't matter. A friend of mine, the former chairman of CCB, used to say, I would rather be the tail of the lion than the head of the dog. So it doesn't matter where we'll end up. It doesn't matter what stake we end up with. Yeah. You're
a funny guy. Yeah. James, I was really surprised on the call what you said about a potential equity repurchase program for Centum, and I'll tell you why. When you released your half-year earnings, your market capitalization was 13.5 billion. As we speak, your market capitalization is about 11 billion. That's 1.8 B just hived off. And shareholders always sit back and wonder, when you look at the net asset value versus what the market is valuing this company at, there's a stark misalignment. When will this value be unlocked from a share price standpoint?
Share repurchase is a return of capital. Yeah. And in fact, we're one of the first companies to speak about a share repurchase.
Absolutely.
And had the environment been different, would have done it. Would have done it because we would not have been as conservative on cash. A lot of the cash that we've used to pay down the debt would have balanced. But the environment is what it is. So we've adopted a more conservative sort of outlook. And in fact, we're having a retreat, and what we're discussing is that we want to separate issues. We want to separate first, as a board, our responsibility as a company, and doing what is in the best interest of the company. That's the first priority. And then separately, then look what is it that we can do around the share price. You're distributing capital. So right now, what we want to distribute as dividend is income, rather than capital, because the priority at the moment, we've not yet achieved the objective of fully deleveraging the balance sheet and the rest. So, but then I also sometimes wonder for our long-term shareholders, if you go and buy their shares at 17 shillings, when the price is 67, the NAV is 67, is it the right thing to do? Because the interesting thing also with our shareholder base, especially if you look at the top 10, it has not changed over the last 5-6 years. So they have a long-term view. So for many of them, and these are the ones who sit on the board, their focus is more on the company than on the price, because they're not sellers at the current, and you can't solve for everybody. You end up solving, you have the short-term investors, you have the longer-term investors. The voices on our board from the shareholders are those of the longer-term investors, and the interest is on the company, and they believe the price will be the price eventually. And you end up, so you have so many constituencies you're trying to address. And we've had that debate, and Chris asked one time, James, do you think it's the right thing to go and buy these shares at that low price? Shouldn't you be working to close the gap rather than buy from poor people? So those are some of the questions that one faces. Yeah.
So James, in that context of what you've just said, what would you see as the opportune avenue for price discovery? Because some have the sentiment that this market maybe just doesn't understand Centum and the business model.
We had this same issue in 2009. The price to NAV gap was 50%. And I think several things have contributed to this issue. One is how we do our reporting. Because if you read the analyst reports, they focus on the consolidated financial statements as opposed to the company. So it's very confusing. And that's one. Two is the liquidity of the share. So the liquidity of the share it's not that liquid. So you don't have a lot of demand from institutional investors. Three, our own insider trading guidelines made it very difficult for shareholders who are members of the board to buy. So again, further reducing the demand. Of course, we've also had uncertainty around Dr. Kirubi. That has also created further. So we've had a lot of external issues, and of course, what has happened with the market. I think the market expected probably the NAV to come down significantly more than it has come down. So as a management team, you then start focusing from what is in your control, which is the performance of the business, and working outwards to then how you communicate it, and then trying to get investors, especially more institutional investors who are better aligned with the long-term outlook of the business. So that's sort of the process we are on. Okay. Yeah.
Now that you've mentioned the late Dr. Chris twice, allow me to ask this question. The market was, for the few I spoke to, really worried about the key man risk factor in Chris and Centum. And what does the post-Chris Centum look like? What sort of assurance can you give?
Chris is a very interesting Kenyan businessman. Is unlike, why people are worried, because the typical Kenyan businessman is an owner-manager, and they manage their businesses. Chris was very different. Chris was an institution builder. And all the institutions he was involved in, there was a board, there's a strategy, there was a management. Chris used to be the chairman of this company in 2003, almost 18 years ago. So yes, he's a major shareholder, but he was not really involved in management, and his contribution was largely at the board level. But you see, Chris also had a larger than life personality. So there's really no impact, because we are guided by the strategic direction the company was taking. And we've had three, we're on our third one, 2.0, 3.0, 4.0. So there's really no difference. There's a board, and I know there's that perception, but the reality is that his degree of involvement, and he's been unwell for a long time. He was unwell since 2017. So his degree of involvement, not just in our business, in a lot of his other enterprises, was not that major.
Let's get back to your portfolio companies. I was a little surprised by what you said about Longhorn, and why is because in my assessment, I could be wrong, is that it isn't as nimble in terms of adjusting to the market realities right now. If you look at the latest numbers, the revenues are quite dissipated by COVID-19. Finance costs are quite high. Are you that optimistic about Longhorn?
I think they've just finished their financial year, June 2021, and you'll see their results. I don't want to preempt the announcement, but they're now profitable, and Maxwell will be explaining what has happened. The thing with the Longhorn is that they are very strong in the educational sector, and they are very well diversified. And when we were doing our risk, at least when the team was doing the risk planning, because I'm not on that board, their risk mitigation was the geographical diversification. We did not appreciate enough that one day there would be an event that would close schools. In fact, we think schools are the least risk. People will cut costs on other areas. But you see, when you sell educational books, you sell to governments and the rest. So 2020 was quite unusual in the sense that schools were closed across all their markets. But if you look at June 2021, they have had a strong recovery. The reason you have high finance costs is because you have to finance for the purchase of the books. And the lockdown came when they were about to supply the books. So you then have high finance costs. But we've seen good recovery in 2020. 2021, we are seeing very strong orders as schools work on catching up. They also have a very strong digital program that they're working on. But I think the big strength of Longhorn that is underappreciated is just the strength of their IP. Because you don't just wake up and start selling books. And that IP does not show up on their balance sheet. And even when eventually the technology moves from physical to digital, it might actually be better for them because the margins will be bigger. Because they then don't have the printing costs and the inventory carrying cost, which they currently have today. So at least as at June, we've seen a reversal of the loss. And as of now, we are seeing them going back to where they were before.
Still in your portfolio companies, the Syrian Bank. Yeah. Quite impressive if you look at their balance sheet, their P&L. But one concern pervades the banking sector in this market, and I don't know how you're pricing this in, is the fact that many banks have not received guidelines from the CBK in terms of risk pricing. Now, in a market where the risk profile is so deteriorated, and you could tell by just looking at the asset quality that many banks are carrying in their books, how do you price that in?
You see, we've had an interest rate cap for a long time.
3 years.
Actually, I think it was more than 3 years. Yeah, 3 years, yeah. So we've had it for 3 years. And sort of that's the environment we've been operating in. And actually, CDN was one of the most affected because we're doing mostly microcredit lending. So we had to pivot to short-term lending that could see us be profitable within that pricing at our cost of funding and at the same time reduce NPLs. So we moved more towards short-term lending, which is cash flow based. Yeah. And I think that has worked for CDN because it has driven, because you see, when you're a small bank, when you're a Tier 3 bank, and you have constrained liquidity, you cannot grow exclusively through net interest income. So we focused more on offering products and services that would also drive our unfunded income, and then use the lending to support the unfunded income activities. So today, actually, our unfunded income is more than our funded income. And it has worked because NPL over aggregate has come from 20 to 11.5%. And if you split that that NPL between the book pre that strategy and post the NPL is 4%. So the bulk of the NPL is still on the old book. And as you get those significant recoveries, this NPL is going to continue to come down. So I think we've sort of managed to figure out a business model that works within the risk pricing model that we have today. So we've found a way to adopt. We are still relatively small. So for you to enhance profitability, you see, if you're a bank with a balance sheet of 500 billion, for you to do 10%, you must do 50 billion of lending. When you're a bank with the 20 billion, even if you do 10%, it's only 2 billion. So you don't have to push we are not the market. We don't have to push the frontiers for you to do very well. And that works well for us because if you can grow we are carrying Sigen in our books at 2 billion shillings. Yeah. This year they're making 50 million a month. So there'll be 600. So we are sort of now carrying it at 3x. If you can push this even from 50 to 100, you've created considerable value on our balance sheet.
You have investment in the airline catering business. And a lot of us are worried about what the future looks like, given how aviation has been impacted by COVID-19.
You know, that's the way the situation is. You see, what do you do? So we've cut costs. We have diversified into corporate catering, but the core business of NAS remains airline catering, and hopefully it will come back when we've seen vaccinations picking up. When that comes back again, it will come back strongly. But it's a fairly resilient business because, interestingly, they have not borrowed. They are sort of able to survive as they are, but it's not what it was before, largely because of factors beyond anybody's control or anticipation. So we are, one can only be hopeful that once then the global environment picks up, there's more free travel, more people are vaccinated, then it will recover. But that's the advantage again of having a diversified portfolio. Yes. Yeah.
The real estate business. Let's start from here. I remember when Centum was going to the market for the corporate bond issuance, we were having a conversation and we were all worried about performance. Looking at the issuances ever since, it looks like the corporate bond market is back. The first question is, do you see a return to the market?
Oh, for Centum?
Yes.
I don't know. You see, we went to the market. Okay, first, what is our business there? We're not really, as Centum, we're not really in the business of building houses and the rest. That's not really our interest. Our interest was to create a real estate platform company that is investment grade, that we could sell, that we could exit. So move from bare land to an entity that has business that is cash generative and that offers a strategic an opportunity to come and set base and start off from there and scale up. And that's what we've been building, and to do it in a capital efficient manner. So we've deployed about 7.5 billion in that business. We've gotten back last year 4.5 billion. They have a pipeline of we're expecting another 5 billion of distributions in the next 36 months. So we'll have all our money back, plus we'll have the company. Yeah. Okay. So why the bond was important strategically is that we wanted to, because it's an investment grade company, we wanted it to be credit rated, to have a listed bond in the market, to start doing their own results announcement as part of the path to exit.
And they actually did their results.
And they've done that. So maybe they'll rebrand now, because we are sort of transitioning them to be an independent portfolio company, and eventually we will exit. So the bond was more than just for us to raise capital. It was to raise the profile of the company as a standalone entity, to get them to people to understand their performance, independent of the parent, and eventually to, probably in the next couple of months or years, to then get a fully priced exit. So whether they go back to the market or not, that is a decision for the board of Centum Re, as it's known today. Tomorrow it will have a different name. Definitely they will change the name. They cannot, we just lent them the name to help them with the transition. It's for their board and management that decision to make. But for us, it served the purpose of sort of moving them towards that direction.
In a sales-driven model as aggressive as Centum's, sometimes I feel a bit worried about market offtake risk, particularly in the present environment.
Yes, that's true.
And I remember in the past, if I'm not wrong, there was a conversation about engagement with a strategic off-taker.
Yes, for some of their projects.
Yes.
So what they do, you see, you want to have a market-funded, a customer-funded business model. So they will not break ground unless they have sold 30%. So of all the units that they are constructing, if you look at their investor briefing, as at 31st March, they had sold 60%. So you mitigate it so they first sell and build. The conversation, I'm their portfolio manager. Because we don't run this as a group. We run this as an investment company. So when I sit with Sam, I'm his humble portfolio manager. So the discussion we're having with him now is how do you adopt technology so that even if you're doing a housing estate of 70, you don't have to build all 70 at the same time. You sell and build only what you've sold. So they're improving that model. So today they are at, as at March, they were 60% sold on what they're building. Today they are at 70%. And then they collect. So today they are collecting, this year they are collecting an average of 300 million shillings a month. They have a receivable of about 7 billion shillings. So it's a receivable funded business. It's very risky if you build and sell. It's very risky because then it becomes very capital intensive and then you have significant market risk. So for example, Loft, they launched Loft in the middle of COVID at 30 million shillings. And I was very skeptical. I said, Sam, will this really work? Yeah. I said, no. I said, okay, don't worry. Let's go and try and see. If it sells, we build. If it doesn't sell, we don't have to build. Now, of the 32 units they're building, they've sold 29. He told me they're selling the remaining 2 today. So it's a sales-driven model, and which is why they're working on JVs, so that they can go to where the customer is, because it's capital light. So wherever the customer is, they can have a product there. But then also we've seen, I think, them build market share because of trust in the brand that it will deliver. So I think that also explains why, because before anyone could deliver for you. Yeah. And I've also understood the market better. Most people don't want to buy their properties with the debt. They want to pay during the construction period. So most people prefer to buy an off-plan unit and pay slowly as opposed to get a finished product and go and borrow. Because we've put in place mortgage schemes for our buyers. Yeah. And of the units that have been sold, less than 5% of the buyers have taken up the mortgage schemes. 95% are paying slowly through the course. So faith in the ability of the developer to complete is very critical, and it's part of our own sort of maybe nature as a market.
2 follow-up questions there. One is the funding risk, because of just what you've described. Balancing your inflows and outflows, I believe then that is optimized through that sort of model.
So the way it works is that, for example, they have the bond. For some projects that were not part of the bond program, they had their bank financing, a project like Cascadia. Yeah. So Cascadia, they have bank funding, but how the bank funding works is that all the deposits go to the bank, and then the certificates come from the bank. So the bank disburses the net. So on Cascadia, they have done, I think they have done 1 billion worth of works. They have only drawn down about 120 million from that facility, and they have a 2 billion facility. So you're doing the net. So that really reduces your finance costs. In projects like in Uganda, we finished, even Vipingo, they were fully equity and customer funded. Yeah. So that's how sort of the model works. So the financing comes to bridge. So you just have it as a bridge, and you're only drawing on the net between the certificate value and what you've collected in the period. Yeah.
And talking about the third-party arrangements and the JVs, then counterparty risk now comes in there. And how do you mitigate that?
So how they have mitigated is that when they're doing a JV, the land tends to be transferred to a new company, which is then owned jointly between the landowner and Centum. Centum is bringing something important. They're bringing ability to sell, and the ability to develop, and ability to raise funding, which a lot of landowners don't have. So the full management of the project then sits with Centum. The reason is Centum is running a capital light model. They don't want to deploy capital to acquire land. They want to go through the entire change of use process and the rest without carrying the cost of land. So that any capital that comes in is just going towards the development and eventual distribution.
Last year, following COVID, there was a downward revision and discounted rent at 2 Rivers. How is that going?
It went down, and tenants either got a rent discount or a revenue-based rent model. And you know, it's like a patient. You have to survive in the short term to thrive in the long term. If you lose your tenants, it's very hard to rebuild that. It takes time to rebuild. So sort of you want to cushion everybody, and sort of as the market picks up, progressively improve. So they've been increasing progressively. I think now they're like 70% of where rents were before. but you can't fully take them up because the trading hours are still short. With a curfew at 10, many shops have to close by 5, 6. So trading hours are short, and you still have to continue. And that's why we've not suffered a loss of tenancy. Actually, it has increased because the long-term valuation of the mall is based on the revenue in a normal situation. I don't think the situation you're in is a normal situation. So you want, when normality resumes, to find you in no worse off than you are before in terms of the capabilities that you have built, because the mall is just, it's a marketplace. If the vendors are not there, then you have no product to offer the customer, so you must preserve the vendors.
And James, your portfolio is still heavily concentrated in real estate. I remember reading the target is to bring it down to an almost equal with the PE. In light of the situation that we are in right now, what's the outlook?
Or even lower. You see, why it's concentrated, there's a heavy concentration in real estate, it's not because we've invested a lot of money in real estate. It's because it has done well. Yeah. So you have today an uplift. We have a cost of 3.5 billion, say on Centum Re. The valuation is 22 billion. And that 22 billion excludes the receivables of about 5 or 6 billion. So it's done well. But the way out is when we exit. Because when we exit, actually, you might go through the same thing. You see, before we were concentrated on FMCG. Yeah. If you do one exit, then in 2 years you'll sit and say, hey, James, what happened to real estate? It will disappear in one, depending on how the exit looks like. So the path out is us just completing our investment cycle and exiting. And I'm pleased with what the team has achieved, despite the environment. They have carried on taking the steps that are necessary to bring us closer to a fully priced exit.
Your marketable securities, understandably quite concentrated in fixed income. Yeah. But given the sort of pricing and valuation we are seeing in the equities right now, do you see an opportunity, or you're still cautious in the marketable?
What the idea was around that, the philosophy was, we went through a very painful process when we started, when we had no money. And you had to borrow to make investments. And you see, you're taking high risk because now you're using borrowed capital. And you know how difficult the exit environment is in this market. Even in Africa, if you look at the average IRR for PE funds, it's like 2-3%. So we went through a high risk phase in the business. And when we were going into 4.0, those of us who are part of that high risk phase did not want our work destroyed in the next phase. Yeah. So we said, guys, whatever exits we do, put them in a high yield portfolio. Risk the income. Don't risk the capital that we built for donkey years, yeah? Blood, sweat, tears, and toil. Don't risk it, because you don't know how you'll perform. You may not perform as well as those. So that's why we went. So it's a change that now, instead of risking debt, you then risk income. Yeah. And so the idea is to build it up to be a cash generating part of the business, pay the shareholder from there, and the balance, invest, take risk with it. Yeah. Say, I think this company can do well. If it doesn't do well, okay, next year you have more income. So it is something we all worked on, including with the late Chris. And I think it's just part of our own succession planning, because of the team that started in 2009, I'm the last one left in the business. So it's part of our succession planning towards a less risky, more sustainable business in the long term. So I think we'll continue building on that, so that in the future, then you have, whether it's an income flow of 3-4 billion a year, you can comfortably pay a dividend of 2 shillings from income, and then the balance, you can make investments without having to borrow. So we want to finish what we had borrowed in the first phase, and have now the new cycle of investments be made. Although the COVID has interrupted us, I think we've made reasonable progress towards that objective.
The first time I interviewed you, you said you don't discuss the operating environment.
Yeah.
a serious executive delivers results irrespective of the operating environment. In this briefing, you have spoken extensively about the operating environment.
Yeah, and I don't like speaking about the operating environment even now. But I also mentioned that the operating environment is your circle of influence, and you focus on your circle of concern and the objectives that we set for ourselves. So despite the operating environment, we set ourselves an objective to deleverage. In 2 years, we've come down 81%. Despite everything that we've had, we set an objective to increase our income yielding portfolio. We've increased it. We are at 75% of target. In 2 years, we have 5 years to go. We did not hit all the metrics, and I cannot say the performance is what I would have hoped for. But we faced exceptional circumstances, which I would never have anticipated. If you had told me this would happen in 2019, I would say it's not possible. Even in science fiction, I would not even have read the book. I would have said waste of time. So we'll continue to deliver despite the environment and try to do the best with the hand we're dealt with. Our focus is to build the resilience of the balance sheet. And it goes down to the question you asked me about the succession planning and the rest. You don't just succeed. People don't just succeed you. You also create an environment that is easier for those who succeed you. Yeah. And that's what we are working on as we're moving from 3.0 to 4.0, is to create an entity that will be easier for those who succeed from where we will live. We will leave them. And my job is to take this company to that level. So that whoever sits in my shoes, you don't have to be, you don't even have to be exceptional. You should be able to do the job regardless of the environment. Regardless of the environment, we should take it to a level where you can just do the job. Yeah.
Unfortunately, that takes us to the close of our conversation with the man in charge of Centum Investment. That's Dr. James Mworia. It's been a delight having you. Thank you so much for your time. And we shall keep on covering Centum and the strategy 4.0. Stay tuned.